freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here with Adam Penn. Adam, where are you today? Where in the world is Adam Penn?
I am in Austin, Texas for a self-directed IRA conference. We were supposed to record this on Tuesday when I had a beautiful backdrop behind me of like a Japanese maple in the middle of like a coastal setting at a beach house we were at for Easter. But there was no internet.
Yeah, every time we hit record and everything crapped out. I was disappointed because it was a really nice. I like your home studio, but that background was a lot nicer. And you could have just turned and we could have had the beach as a background, right?
I was in like the center atrium. So the house is like a square and it has like a center area with like a hot tub and then like a garden. And I was in that center.
Gotcha. Well, we'll take the hotel room, I guess, even though it's not as picturesque as the other.
The hotel room that we were joking about before, and he's going to yell at me for this, that when you hit the table, the light flashes.
Oh, the joys of travel, right?
Uh-huh.
Well, what we got on tap today? I think you've got something up your sleeve, right?
I'm wearing short sleeves.
Well, okay, it's still up your sleeve. You're not wearing a tank top.
I could put one on if you want, but
no, please don't.
So yeah, we wanted to talk about kind of an oil and gas deal that we're putting together, and not so much because we're raising money for it, which we are. So if you're interested in an oil and gas deal, please reach out. But more so because it's different than ones we've done. And I've said that a few times over the last few oil and gas deals we've done. And that's not to say that the ones we did before were bad, except for the one that we did 3 times ago where we lost a bunch of money. That one was bad. But other than that, it's just been that we've either learned something more about a strategy or we've been able to add to the plan that we have. And right now, and we'll dive into this a little bit more, but the 30-second overview is that we're able to drill a lot more wells. We don't have the same tax benefit we've been having in previous deals, but it's a much larger portfolio, and it's because we're buying some existing production. And so because we're already buying production, you are cash flowing. And so when you finally go drill some wells and you get a tax benefit, you're just offsetting the existing cash flow, which is something I think a lot of investors don't think about when they initially think about oil and gas. You go standard example, $100,000 investment, going to get an $80,000 deduction, wipe out $80,000 of income, which is great, right? A lot of people that's where they're going to get most of the money for the investment, or 30% of the money is by that tax savings. But then next year, if we perform to the metrics that you're hoping we perform to, right? Because you need this money back too, investors do, or we do when we invest, then it is taxed as active income. So you're just creating a bigger tax problem, right? The problem kind of keeps snowballing, which more money, more taxes, it just means you got to come up with more ways to try to change things around. And that's not sorry, go ahead.
No, I was just going to say that's the nature of taxes too, right? Like regardless people are in real estate very familiar with 1031 exchanges, right? It's not a 1031 your tax goes away exchange. It's a 1031 tax deferred exchange. So that's something. This is a bit of an aside from this. I guess the main focus of this episode, but it's something to keep in mind is that anytime you're talking about tax benefits, it's a deferral game, right? Like you're not very rarely are you making them completely go away. Now, maybe the oil and gas, when you can wipe away W-2 income, that sort of reduces that. But anything where you're talking about deferring tax, it really is a game of like kicking the can down the road. And to your point, the same tax advantages that allow us to take that in most of the oil and gas deals that we do, that allow us to take that big first year tax break, then now also create a tax problem in subsequent years. And so then now it's like, okay, well, we got to figure out some way to offset that tax problem. And so all of this whole tax space just becomes a giant game of figuring out ways to kick the can down the road. And there's nothing wrong with that. You could do that very successfully and do that until you die, and then everything kind of goes away, or your heirs have to deal with it. But that is an important distinction here, is that even any time that there's some sort of tax break, you do have to kind of look for what the flip side of that is, and it usually is just some version of kicking the can down the road.
And I think really let's take a second and dive into why we like oil and gas deals, and I think that's primarily because we see a drastic underinvestment and over demand, right? I mean, we're not producing more every day. I think the well count has gone up over the last 4 years or so, but it's not drastic. And especially with oil prices being a little lower right now, I know we dipped into the high 50s. I think we've settled back into the mid 60s, but that is not super profitable for a lot of the shale plays. Most of the deals that we've done that's still profitable, it's obviously every time the dollar it goes down, it becomes less profitable, but it is not. There are operators out there that need $60 oil to break even just based off of the way their business is built.
That's the standard shale baseline, right? That you hear people say is usually $60 is kind of the break even point for most shale producers.
Yep. Which is why I don't remember what Trump said, what his target was. Didn't he say he wanted $40 oil or $50 oil or something?
Something like that, yeah.
And that's just funny to me, right? Because you would end up with a lot of shale producers going out, and then not a lot, but I think a decent amount, which would then kill the supply, which would then drive the price back up, right? And so really that alone is why we really like this space, right? I had a conversation with someone the other day, and let's just say we weren't politically aligned, and we were talking about investing, and eventually I was talking about oil wells, and they're like, "Oh, you own oil wells?" And I said, "Yeah." And I'm like, "Oh, I don't think I'd invest in that. I'm more of a green energy person." And I'm like, "Well, okay, but it takes a lot of oil to make a windmill, or to build a solar panel. You got to mine a lot of silver to build a solar panel and produce it and ship it all around the place and then install it. And you normally install it on like asphalt roofs that are also made out of oil and all of those things, right?" And they're like, "Yeah, I know." And it was just the end of the conversation, right? And so, to a certain extent, I'm fine with people wanting to be in the green space, right? I want things to be greener myself. I like nature. That we were just talking about the beach. But I think people kind of have their head in the sand a little bit about certain topics, right? It's like they know the problem, right? They know that that this needs oil. They know that doesn't really solve it, but they're like, it's green, right? There's no emissions coming off my solar panel on top of my house.
Yeah, or my electric car doesn't use any oil, and it's like, well, how much oil went into the production of the electricity that eventually went into it?
Or your tires.
Yeah, or the tires, or the plastic body components, or the plastic that's inside of it, or I mean, there's no. Maybe at some point in time in the future, we come up with some sort of solution for free energy that doesn't involve oil. But even then, from an energy production standpoint, you still have the production of all the goods that we use every single day that requires oil as an essential part of the manufacturing process. And so I definitely I agree. I mean, I've got nothing against wanting to be green and environmentally responsible, but you also have to recognize reality, right? Like there's no real getting away from the fact that significant demand for oil is not going anywhere, and it doesn't really change like how green people want things to be. Like it was so ingrained, and I always love that chart of like the oil consumption versus GDP, right? And it's
I'm actually trying to pull that right now. It's like R equals 9.82 or something, right? It's not the GDP of developed nations is incredibly tightly correlated to oil consumption.
Yeah.
So as the world becomes more industrialized, it's R equals 0.993 for all your statisticians out there. I mean, that is, there's no more closely correlated asset there. It's you need oil to grow, and that might not be true forever in the future, but right now to based off of the energy sources we have, that's just where it's at. And so that's really, I think, the why behind why we like these investments, right?
For sure. I mean, there's that I talk a lot about in all investing that there's you don't have to overcomplicate it, right? And so many things are simply so many things in being successful in investing is simply finding ways to exploit supply and demand imbalances, right? And that's we see that, think that's what's about to happen. All signs point to that about to happen in multifamily with no new supply and continuing demand. I think there's a play to be made for boomer businesses and the coming silver tsunami. And again, it's just like demand, right? And it's the same thing for oil. Like if we want to continue to have a highly developed nation and we want to live in that and we want to participate in that society and that economy, there's currently no alternative to oil. And so a growing economy in the US is 0.993 correlation to oil consumption, and so it's just going to continue to go up. So yeah, I mean the background demand for oil is not going away, and so it means that there's as long as that's there and increasing, it means that there's opportunities to be made, regardless of any other headlines or anything you might be seeing, or larger narratives. Like it doesn't change the hard facts on the ground that demand for oil is not going anywhere.
Yeah, let's spend a minute and talk about what it is that we like about this new deal, right? Kind of what sets it apart from other ones we've done. And once again, I mean, this is, reach out to us if it's something you're interested in. This isn't supposed to be an investment overview, but just talking about why we like this one, or really how it differs. And the first off thing is it's the largest deal we've ever participated in, right? Most of the time, the biggest thing I've done is 10 wells, and even that was a $30 million play to do 10 wells, because we were funding 100% of all of them, and it was drilling, right? So we'd have to go out and we have to drill 10 wells, and that took 2 years for us to go do, right? It was a smaller operator. They had operational issues. I mean, things happened, right? And so it took a while to drill 10 wells. And now they're cash flowing, and it's a performing it's a performing investment now that we've got all the wells out there drilling. But the second part to that is you don't have to go buy drilling rights. You can and then go drill the well. You can buy existing production. And it's just Dustin's going to say this better than me, but you just take the cash flows that are currently there and put a price on them, right? And you're paying for those down the line. And so right now, what the group we're working with, which is Aspen Funds, the same group we worked on with our credit fund, they've got some good connections, and we're all partnered with a company named Mahajer, and they have a lot of experience in the oil and gas industry. So we're looking to go buy kind of a key asset, and we've done this a handful of times before. Go out and buy a key asset, 600-700 wells, get the cash flow off of that, then slowly bolt on other well packages. If we go find a 10 well, a 20 or 30 well that are good existing production, we can do that. But we've got a core asset. It's about a $50 million, $80 million project, all said and done. And then we're taking a lot of the cash flow, about 30 to 40%, all the year one cash flow plus about 30 to 40% going forward, and reinvesting that into drilling. And what that does is, because we're able to buy this land with existing production, not really paying more for the right to be able to drill there, right? We're really just basing our purchase price, or at least our underwriting, based off of the current cash flow of that portfolio, the amount of barrels it makes every day. Then we're able to take the new cash flow, drill new wells, increase our cash flow overall, because we're drilling new wells as the other ones are depleting. And so if we can get up to like 1,500 wells is roughly the target. If we can get up to 1,500 wells, we've added a lot of value, right? Because we've added a lot of cash flow to the portfolio, even as the existing wells are declining. That's allowing it to grow and then have some type of exit down the line.
With no additional capital investment. It's simply reinvesting the cash flows of the existing production.
Yeah. And while still kicking off cash to the investors down the line. And then once again, reach out to us if you want to know more, but it's we won't dive into specific numbers, but that's a really interesting theory, right? Because you're able to, it's like when you look at a multifamily value add play and you're like, hey, the cash flows on this property, it's great. It's fully occupied. We have no need to get in here. We're not doing the value add 2-month turnaround on a we got to turn 10 units every 2 months, but hey, we got plenty of cash flow. We're going to rehab a unit whenever they come vacant. Plenty of cash flow. We'll just do it out of the cash flow. We're not going to go raise $500,000 to do a rehab. We're just going to say, we made 15 grand this month. The rehab was 10. Distribution for April is lower than it was for February and May because we've got a rehab that we did. Similar idea here, right? They've just built it into the budget that we are going to essentially go participate in new drilling. We don't have to participate, but if we choose to participate in new drilling, we'll take those cash flows and about 40% get reinvested into that drilling opportunity, which just boosts the cash flow, right? So as you go drill new wells, and now you're instead of making, we'll go with an easy example, $100,000 of revenue. Now you're making $110,000 of revenue. When you're still investing 40%, right, that starts to compound. And so now by year 5, maybe instead of investing 40 grand a year, you're investing 100 grand a year because you're up to $220,000 of top line revenue.
No, I think that's a great analogy of like rehabbing a apartment building or something like that, rehabbing the units with the existing cash flow as opposed to raising outside or raising additional capital and then deploying that into it, because it's exactly what it is, right? You're using the cash flow from the existing asset to take action that's going to increase the value of the asset overall. So I think that's unique, right? Like this is not you mentioned there's actually a lot of things about this deal that are unique from the other oil and gas deals that we've done before, which are the size. I mean, this is massive, right? I mean, we've done a lot of like 4-well deals, right? And it's been a nice size.
And now we're going to go drill 700.
Yeah.
Right. And we don't have to go get capital from the investor every time we want to drill a new well, right? We've just got to get capital in this initial cash flowing deal. And then that's where we're going to get the tax benefit, right? The tax benefit will come from the new drilling and will offset the cash flow from the existing production. So you end up having a really tax beneficial investment. You're not offsetting W-2 income. I get it's a different play, but by golly, it's a lot safer.
Yeah. And that's the piece I wanted to touch on that I think is maybe the biggest difference. We talk to a lot of investors about oil and gas, and obviously one of the things we love there is the tax benefit, partially because when we're directly investing in drilling and we're all sitting as GPs in the deal, we get that W-2 all income sort of tax benefit.
Mm-hmm.
And that's not going to be the case with this one. And I don't think either of us see that as a downside, because it's just a different profile of a deal, and we're getting a tax benefit, that same sort of drilling tax benefit, just in a different way that's really shielding a lot of this income later on from taxes. And so it's not just that like year one hit. This is a really, really is a heavy cash flow, but a very tax advantaged cash flow play.
Yep. And really that's, even on top of that, we're able to form this through an LLC, right? Because we're not trying to get that pass through tax benefit where everyone has to be a limited partner or general partner on a limited partnership. So there are just some different aspects around this, and that kind of moves me into, how is this possible, right? Because I think maybe given the choice, I still like the oil deals that we've done. We're still going to do more drilling ones. Well, another reason that we're doing this right now is it's early in the year, right? We're not everyone searching for a tax benefit right now, right? So if we do this one and then towards the end of the year we can do another tax beneficial one, I think that works out for our investor base, and for us as well. But the how we're able to get these versus what we had before is really that partnership with Aspen, right? It's just different than the other type of assets we've done, and that comes back to just the size of what Aspen does and why we really like working with them, and just they take a different approach, and I think we see that in the little things they do in the fund, that like they have a hedge against the oil commodity price, right? They're buying puts and they're selling calls, and they're essentially, we need to verify this, but we believe they're covered calls, right? Because they're the producer, right? So we don't see how they're not. We haven't dove into the specifics of their hedging strategy, but we know they're selling calls and we know they produce oil. So I think this is another thing that allows them to stabilize that baseline. We just saw a big dip down in oil to below 60. And most of their puts on their current oil and gas funds that they've worked on previous, their current call options their current puts are in the 60s, right? So that stabilizes their baseline. Yeah, they're not going to see excised returns when you get to $100 oil, but they're able to really stabilize their baseline there.
Well, the benefit of I really like the hedging strategy on this because again, I think that this is just another way that makes this deal unique from other things that we've done because it really does protect against that downside, right? Like it effectively, again, we need to verify some of the mechanics of this with them, but based on everything that we've learned so far, it seems that they're basically selling these call options using the income from that to then turn around and buy a put to protect against the downside. And I know that that's getting into some fairly technical financial jargon, but the benefit of that is there's basically able to protect to buy an insurance policy against oil prices falling for free is essentially what's happening there. And then of course that protects on the downside, and then on the upside, if none of that happens, well then that's great. We just sell oil at the higher price, and production's like the income from production is higher. So it's a really neat way of continuing to we talked earlier about a lot of shale plays have that $60 a barrel sort of break even. I think, Adam, correct me if I'm wrong, but they just in general, this deal as a whole, they're projecting that that's in the 40s is their break even, and that's before accounting for the hedge, correct? Okay. So there's a ton of downside protection in this deal in so many different ways. And of course, there's risk in all investing, right? And we're not trying to say this is something that's like super low risk or something like that. But from all the oil deals that certainly we've done and been involved with and that we've seen, there are more factors on this one that are adding protections to the downside than certainly that I've ever seen.
I think to me, the way that I look at this one is it's a lot more like your value add multifamily, where it's just much safer, right? You're not gonna, but it's uncorrelated, right? You have an energy producing asset versus a rental asset, and so you're able to participate in that other commodity without having to be super exposed.
Yeah. And maybe to continue that multifamily analogy here, the difference in that is instead of if you have a unit sitting vacant, you've now got effectively a guarantee that someone's going to be able to pay for at least something for that vacant unit, so that it's never truly zero.
Yeah, rent insurance essentially.
So yeah, it's super interesting. I mean, there's some financialization aspects to this deal that I just kind of having that background I very much like. Adam referenced earlier about the buying existing production the buying at the present value of future cash flows, and so effectively you've got operators or owners or other people who are willing to take the cash they need or want cash today, and are willing to pay less than what the future cash flows would eventually be for that. And so we can then come in, put up the cash today, and then now make the difference on that, right? Where and what's been projected is a 15% or something like that, I think is what they're targeting, about a 15% discount.
Yeah.
So that's where a lot of the future returns are kind of built in, is projecting out, okay, what's the
current price of oil, right? So
correct.
As oil, and once again, our macro view is that it's a highly demanded commodity that will continue to increase in price. As it goes up, let's just say 5 years from now, we're sitting in the $90. I think 5 years from now, we could be over 100, but who knows? Even if we're up in the 80s, right? It's still a profitable play. Our base case is a $75 average oil price, and our downside is a $60 oil price. Once again, that's on the sale. So if we went down to 40s, we're going to have to not sell for a little while, but we're still producing and we're still buying these. We're still hedging that commodity price on the cash flow side of things.
And the puts are in the money at that point.
Yeah.
Which then makes them attractive. You sell those, that produces income to offset what's lost from either not selling the oil or selling at a lower price. So, this is a very unique deal, but it's really, really interesting. And I think for investors that are looking for cash flow, that are looking for sheltered tax flow, or sorry, tax sheltered cash flow. There we go. We'll dive into the details of a collar option strategy, but I can't say tax sheltered cash flow. I think this makes a very compelling investment. We like investments that cash flow. That's kind of our primary focus, and I think this is a great one, and it's in a real asset. It's in a strategy that's got a lot of built-in downside protections, and I think it's a neat deal. I was really excited about it.
Anything else you want to touch on this?
No, I was going to ask you the same question. You're definitely running point on this. Anything that you want to touch on that we haven't covered already?
No, I don't think particularly there's a whole lot. The big thing is it's just not it's not a big tax beneficial play up front, but it is still down the line, right? You buy it's almost in the same way an apartment building spits off depreciation. This is depreciation that everyone can use, right? Because some people, the depreciation is not going to do a whole lot for them if they're a W-2 earner. At least these IDCs are going to offset the income coming from this.
Right, which makes it a much more attractive investment for someone that would invest out of a taxable account if it's just going to be out of cash or something like that. Or even you still could invest through a retirement account, and if you ended up having other investments in there, like a multifamily building that was subject to UBIT or had some other tax some tax implications within that, this could help there. So there's ways to put all these things together. And if obviously if this is something, if you're hearing this, interested in it, reach out. We'd love to talk more. It's a really, really neat deal, and excited about it. While I'm on the topic of reaching out, I always like to throw in, we'd love if you are enjoying conversations like this, learning about deals and deal structures and sort of these things. Give us a like, smash that like button. I hate that phrase, but definitely do that. The algorithms, they pay attention to those things. So if you're getting value from these episodes, definitely like the episode. If you're on Apple, give us a rating, leave a comment. That'd be great. And on YouTube, hit the like button, subscribe to the channel, all those things to help tell the algorithm that this is good content and they should be showing it to more people. We definitely appreciate that. All right. Well, Adam, if you don't have anything else, we can get on out of here.
Let's get out of here.
All right. Everybody, thanks as always for watching and listening. We appreciate it. And just remember, where freedom leads, real wealth follows. We'll see you next time.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.